Good morning. How are you doing? Happy NFP. Man, you look good. All right, who's hot to go? H-O-T-T-O-G-O. Hey, I got to get the chat link. Hang on. Pop chat. Hang on, I'm almost there, Bubba. I want to put the chat into the stream so we got a visual. That just takes a couple seconds. Then I'll kill the music. Welcome to Trade Non-Farm Payrolls Live. Did that do it? Looked like it wasn't going to do it. Anyways, welcome to Trade Non-Farm Payrolls 220. Did you know that that's a lucky number? Hang on, I know the music. Hang on, I'm trying to find all this stuff. See, I'm not used to trading on just two windows, two screens. All right, there we go. We killed that. Yeah, hey, welcome to Trade Non-Farm Payrolls Live, month 220. Okay, look, I paste that in there, and it doesn't update. What's the deal? What's the deal? It won't update. Anyways, I guess we're not going to have chat today. Not in the window anyways. That's all right. All right, let me get back to the world. Maybe I'll try the FXStreet provided me the chat. Maybe it didn't grab the whole URL when I did. Let me try one more time to get that chat on the stream. Meanwhile, let me see if I could do this and a disclaimer at the same time. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. No, the chat just doesn't work today. Well, not on the stream, but I do see you. Cool. So how you doing? Everybody having a great time? Life is great. Life is good. Life is beautiful. So today I think we should do some fundamental analysis, and I think we should do some technical analysis. I think we should do a high volatility event-driven strategy, and then we can talk about scalping, spot, swing, trade, carry, anything actually you want. What do you stink? Smell like a plan? Cool. Yeah. So my name is Wayne McDonell. I've been doing this webinar at FXStreet, just this one webinar, which is now, of course, a live stream, for 18 and a half years. Just this one. I've been doing other stuff at FXStreet for longer than that. Shut the back door. Okay, so yeah, so I've been trading currencies and commodities, spot and futures for a minimum of 20 years, probably a little bit longer time. Well, I guess 22 years. Before that, I was a venture capitalist. Before that, I was a Silicon Valley high-tech entrepreneur. And before that, I worked at little companies that you might have heard of, like Cisco Systems and Apple Computers and NASA, all in the Silicon Valley. Yeah, cool, right? Yeah, cool beans. Yeah, I worked at NASA. True dat. And then during the early to mid 90s, I worked in the nonprofit world and became a leader in a nonprofit organization. And I sat on the board of directors with George Soros and the former CEO of AT&T, Vice President of General Electric, a bunch of others, someone from the United Nations, which is cool because I still work for that organization 40 years later. I still volunteer. I now manage 3 endowments, and when I was interviewed to do that, one of the people that interviewed me worked at the United Nations. She called in from Geneva. Yeah, I'm like, oh my God. So anyway, so that's me in a nutshell. I like Thai food. I like walks on the beach, and baby horses. The problem is I like to eat baby horses. No, Wayne, don't say that. That's so cruel. Baby horse burritos. No. So anyways, oh, that is horrible. So anyways, cool. So who are you? What do you want to do? Technical analysis, fundamental analysis? Well, over the 20 years, I learned a few things about technical analysis, and I boil everything down to basically moving averages and pivot points. And both of those include price action. So what are the most important things out of all that? Well, if you don't know how to do price action, you don't know how to trade. You've already failed. Just whatever. You just don't know jack. Okay? You have to know price action. Because then you don't understand the moving averages or actually any of the technical indicators. You won't understand what they're telling you if you don't understand how the price moves. Make sense? Yeah, of course it makes sense. Okay, great. The second thing is, once you have price action, you don't really need moving averages. I use my moving averages in a very specific way. But I really, really like pivot points. I've been teaching pivot points since nobody else has taught pivot points. I'm not even joking. I used pivot points when nobody used pivot points. So, well, nobody in Forex anyways. So I feel comfortable with pivot points because they're like price action. They're a leading indicator, but they do kind of help me identify when the price action is likely to reverse or stall out. Price action in of itself doesn't really tell you that, but pivot points help me sort of guesstimate. So I really like them. I don't really need moving averages. I don't really need oscillators. Some of the other tools, I don't really need them, but they are helpful. Okay. So I spent about 10 years learning technicals. And then in, excuse me, 2015, I guess. Yeah, somewhere around 2015, I went on a little educational journey called Harvard. And I got a bachelor's degree in macroeconomics and a master's degree in financial management to help me with my fundamentals. Now, I knew a lot about fundamentals, and I was first exposed to fundamentals when I was studying for the Series 3, which is an NFA / National Futures Association / Commodity Futures Trading Commission examination. And suddenly, for the first time, I was thinking about the cause and effect. When you do technicals, it's just tactics, so it's just effect. But I never knew why things changed direction and why things would run sometimes and not run others. And it turns out it is fundamentals. It's the why. Why are things happening, right? And I was first really exposed to that through that Series 3 examination, where I had to learn about being a grain elevator operator and having to hedge price moves in the markets, and identify that risk and then hedge. And I'm like, really cool. And then I learned like farmers use options and futures to hedge the crops in the field, right? The crops in the field. And so like, that's where I was exposed to that. In fact, I think I'm going to go to FarmCon this year, which is in St. Louis. I spent, in the last 3 months, I spent 5 days with the St. Louis Fed. 2 of them I was actually at the St. Louis Fed in St. Louis. And then suddenly I have this opportunity to go back to St. Louis, which I find really funny. But there's this big thing called FarmCon. And apparently it's farmers not talking about farming, but basically hedging the financial markets and using their strategies. And I want to know everything. I just want to know everything. So anyways, this is fundamentals. Like how are people looking at the market? How are people reviewing the market? How do they identify risk and opportunity depending on the constituency? How do they position themselves or disposition themselves, if that's such a thing? And those are the fundamentals. And that's where you start incorporating seasonality and oh my gosh. So that's sort of my journey. Like I spent 10 years doing technicals. And then that Series 3 stuff, happened a lot earlier than that. That must have been, I was licensed and registered in, I don't know, 2005, 2006. So, but I learned that stuff and it was interesting. And I really had to study because I really didn't know anything. When I first started trading Forex 22 years ago, I didn't know anything about anything. I didn't know anything about the stock market. I was a venture capitalist. The stock market was for losers. Now, what do I mean by that? Oh, I'd invest into a company for like a penny per share, right? Make some moves. 2 years later, IPO it and sell it for $35 a share. What kind of loser would buy that? That's, it was a place to dump your stocks on a bunch of knuckleheads. Well, I'm exaggerating, of course, but oh yeah, I would like to buy something for a penny and sell it to somebody else for $35. Yeah, sure. And you're like, but Wayne, I went from 35 to 100. Great. They made 3 to 1. I made 35,000 to 1. So I was never interested. We laughed at those people. Now that's not quite true, but I'm exaggerating for effect, right? But honestly, like the stock market, not interesting to me. Okay. And so when I got into trading and investing on my own and not as an institution, it was eye-opening. But I did start with technicals, just like you. I started with technicals. There were no gurus. There were no books. There was no YouTube. None of that was around. I was just on my own. So I sat down and figured it out. So by and large, what I do is generally accepted techniques because they work. I do a couple of things quirky only because I'm self-taught. But if you've attended all 220 of these live streams over the last 18 and a half years of this one webinar, nothing has changed. I have not invented a new awesome strategy of the month. If a guru offers you, hey, take my training course. I have a new trading strategy that will help you get rich quick. Well, that's just dumb. It doesn't make sense. Why would you want something new? Why don't you just do what works? Okay. And if some guru just figured it out, well, what the heck have they been doing for the last 20 years? Oh, well, selling courses somewhere else. So anyways, I do sell courses, but I care. Now that sounds weird, right? Oh, I'm a guru too. I'm a YouTube guru too, but I'm different because I care. But get to know me. Okay. Ask my therapist. I am different. I am different. All right. So just quickly, before we get into the presentation, resources that I like to use. I'm going to use the Trader's Way MT4. Yeah, remember MT4? Yeah. Anyways, I'm going to use the Trader's Way MT4 platform. Why Trader's Way? Well, I've been working with them over 10 years, bro. Okay. And they're an ECN. Okay. I recommend using an ECN. That's it. And there's not many of them, but this one is mine. And an ECN just uses straight through processing, STP. And what that means is when you click buy or sell on the platform, the order goes to the ECN and then into a liquidity pool, and it's out into the interbanking system. What most brokers do is you click buy or sell, and they just put it into their pool of other clients. It doesn't go to Goldman Sachs or JP Morgan or some billionaire in Taiwan. No. It goes into their little dark pool. And they just expect, the business model of all other Forex brokers is they expect all their clients to lose money. And so one loser offsets some other guy's winner, but that winner is going to lose his money later. It doesn't matter. And eventually everybody loses. And they make their money based on the idea that you're going to lose. So it's actually in their best interest for you to lose. I don't like that. Right? I don't like that at all. So I like ECNs. So check out Trader's Way, do your own due diligence. I'm also going to use TradeRs. So I'm going to bring this up. Okay. I'm going to use TradeRs. It's just an automation tool of mine that watches 7,500 charts in real time. Wait, whoa, say what? Yeah. So you try to figure things out and you miss everything, or you trade the wrong thing. I have a machine watching 7,500 charts in real time and tells me like the handful, the 5 or 6 or 7 things that I should be looking at right now and why. Cool. So it takes me seconds to do what takes you hours. And it helps me make better decisions. Whoa, bro. Yeah, that's true. I also have another service, okay? Another software service that does fundamental analysis for me. So I know what to buy and sell and why, and what to avoid and why. And there's more things to avoid than opportunities. So you have to look at like institutional positioning. I actually tie into the central banks directly and pull data. So this surprising 0.15% interest rate hike that the Bank of Japan did earlier this week, I had that plotted on a chart 3, 4, 5 months ago. So when it happened and the news people went, oh my God, right? And CNBC and Bloomberg, they're like, oh my God, that's surprising. I'm like, I had it plotted out months ago, months, not even days, months ago, all plotted out. How did I know? The Bank of Japan already told us, but they didn't tell us verbally. I'm plugged into their API. So I have their projections 18 months into the future, and everybody else doesn't know jack. Cool. I have a strategic advantage. Okay. And I organize my thoughts. So like, for example, hey, I get this all the time. Hey, Wayne, what do you think about gold? Okay. Let's take a look. And I would pull it up and somewhere on here would be gold. And well, that's what I think. I don't have an opinion. Okay. I don't predict. I prepare. Cool. So we're going to use these tools. I also train people. I am a guru. I hate it though. But that's not like my goal in life. So I used to have a course that cost well over $1,000. Then COVID hit and I dropped it to 88. And now I've left it there. So rest assured, if you and I don't have a relationship yet, and you don't trust me, and you think I'm just doing all this so I can get rich, buy a Lambo, and date Instagram models, well, I'm married to an Instagram model. So no, I don't drive a Lambo. I don't want one. I need $400,000 not to buy a Lambo, but to put children through college. I'm a real person. Yeah. So anyway, so it's $88 a year, bro. Yeah. And then I have some live groups. Yeah. You know, they're good. They're really good. I'm telling you, they're really, really good. So, yeah, I've been around. Cool. So anyways, that's it. No, guess what? By the time we meet again, all of these resources, the training, the coaching, the fundamentals, everything is going to be into TradeRs. Yeah. Okay. Well, you know, when I worked at Abdul, when I worked at Apple, I bought shares at $6. And I held on to them for decades. Okay. If I wanted to be a YouTube guru leasing a Lambo to impress you, I would. Look at my credentials, and that's enough. If you look at what I've done with my life, that's enough. I don't need a Lambo to feel successful. Okay, so let's get on with it. You guys ready? Good? Hot to go, HOTTOGO. Again, thank you to FX Street for hosting us. If you look at the bottom of the screen, oh, look, SOM. I want to talk about that. What about SOM? I can talk about that if you want. That ticker tape is from FX Street. Thank you, FX Street, for being an amazing resource. Okay? And honestly, when I started, again, when was it? 22, 23, 24 years ago? FX Street was the only source of information about retail Forex in the entire world. And that's why when I got involved in this industry, I wanted to stay close to them because I valued them as a resource and then later on as friends. So I'm still in contact with, one of the co-founders. We chat every so often, not about Forex. And I sent, so he's a venture capitalist now. And sometimes I run into a startup that I think he'd be interested in and I send him deals and, we're still in touch. Yeah, so cool. They're good people. And so thank you, FX Street. Okay, so I am going to log into TradeRs. Now you see preview mode. And so you're like, what the heck, dude? I'm in the development server, and we're in the process of moving Investor Bootcamp and QuantBox, okay, which is training videos, 100 hours of training videos. Think about this. The coaching rooms and all the recordings, adding community, adding all the fundamental stuff that sits on the Google Cloud, and moving that over to TradeRs. And every single one of these uses different technologies. So it's a big deal. But let's get going with it. So if you just wondered what that was, like for example, I'm building this community. Here's like how things are going to look. This is still demo. I have to add content to it. But like, for example, you could post a chart and say, can you help me with this? And people can respond. Now that's sort of the quick and dirty, just to say, what's up, fellas? But when you click on go to community, there's a whole community where there'll be special events like book clubs and movie nights and access to people that can answer your questions like, hey, where do I find this resource inside of TradeRs? Or how do I do this setup? Or what does this fundamental data stuff mean, right? Whatever, you have access to people. So the community is fantastic. We're going to have a ton of fun. I used to have it in, I think it was FX Bootcamp back then. And we loved it. There's some gamification and all that. Like, it's really good. So I just have to rebuild it here. But I also reorganized all the 100 hours of training videos because it used to be like pages and pages of stuff. And it was hard to find. But if you want to learn about macroeconomic principles, like, for example, you click on there and now it brings it up like this. Beautiful, right? Right? Long run aggregate supply. Very cool compared to GDP, right? Okay, great. So look at all these. Now it's organized. Solo growth model, part 1, part 2. Great. Financial market overview, supply. It's nice and organized. And then let's do a solo growth model. We'll pull that up. Full screen. It's beautiful, clean, easy to see.
All right, record on this computer. Impacts output. So again, 1 unit here gave you a full unit of output. 1 unit here gave you almost no, right? Very little, 20% of 1 unit of capital from 1, or 20% of 1 unit of output cost you a whole thing of capital. And then out here is even.
Okay, great, right? Like, dude, this is good. I'm telling you, this is good. But that's why that little blue thing is up there, because that is not actually on TradeRs yet, but it is integrated. So we're really, that's probably September 1st. So by the time we meet again, everything's going to be on here. Yeah. So let's get into the fundamentals. I think we should quickly talk about the Somme because it's in the ticker tape at the bottom of our lecture. Okay, Claudia Somme used to work at the Fed. And she is the person that created inflation in the United States. Oh my God. That's bold. Why would I say something like that? It was her fault. Okay. Claudia Somme created a model, and today is a big, big, big day for that model. We either trigger something at the Fed or we don't. I'm not going to go through it because it's like the change in employment relative to the, year over year relative to the 3-month average. And it's all this stuff, right? Like, that doesn't matter. Here's what happened. She created a model and took it to the Fed and said, hey, when this thing triggers, it says you should just give money away for free, and you will soften or maybe even avoid the economy going into recession. Or if, like, for example, if a recession would drop GDP by 75%, well, maybe if you do what she, if you give money away for free, it'll only drop 45%. That kind of stuff. Like it'll shorten any recession and speed things up. And it's true. And it has to do with how quickly money is spent. So if you give a poor person a tax write-off, tax cut, how quickly does that enter the economy? It takes years for it to have any impact at all. Well, if you gave a poor person $10,000, how quickly does that enter the economy? The same day. So anyway, Claudia had this idea, and she went to the Fed. Just give everybody money for free. Now this is not quite. It's not quite true because the Fed doesn't give away money. The Fed gives away credit, right? But the Treasury gave away money. But nonetheless, it's the same idea, right? So here's the thing. Yes, when you give away money for free, literally put cash in people's hands, then they tend to spend it immediately. They go to restaurants, they go to the grocery store, they buy clothes, they pay their rent, but it enters the economy instantly, which is different than a tax write-off or a credit. They make interest rates more affordable, so you're more likely to borrow money from a bank. But we know most people don't use credit that way. That's mostly business and rich people focused, because a poor person can't qualify for a loan, so it doesn't matter if the loan is cheaper. You see what I mean? But if you give somebody $10,000 in cash or $5,000 in cash, $1,000 in cash, it gets spent immediately. So that was Claudia Somme's idea. You can avoid a recession or soften a recession by just deploying cash. Oh yeah, she forgot about the whole inflation consequence of giving everybody monopoly money. So she's the one that created the inflation. It was her idea. Now, sure, somebody else had to listen, but it sounded good. Or maybe it was just a consequence of you had to do something. Otherwise, because this is all due to COVID, if you didn't do something, people would starve in the street. Okay, I got you. But you have to be ready to, be ready for the negative consequence of that action. And of course, for some reason, nobody was ready because for some reason they thought it wouldn't be inflationary. Well, what do you mean? I have a book right here written 40 years ago that explains the only way to create inflation is put fake money into the economy. You either print money at the Treasury or the Treasury sells ungodly amounts of bonds, which is just borrowing. So you either print the money like a counterfeiter or you borrow money like someone putting, money on a credit card. And then you take out another credit card and you borrow more money. Then you take out another credit card and borrow more money. Either way, it's not good, you see? And what's the outcome to that? Inflation. I mean, we've known this. He spent his whole life telling us this. That's Milton Friedman, by the way. It's the only way to do it. So for someone, excuse me, for someone working at the Fed or for somebody working at the Treasury, for them not knowing the negative consequence, that's almost criminal. That means they don't know what they're doing. Well, certainly negligence, right? Or they just knew it would happen and they'll deal with it later. And we'll clean it up later. Well, the Fed is in the process of cleaning up literally what they did because they issued credit, not money. So they bought all these bonds. The bonds are maturing. They're not buying new ones, and they can sell off some of the bonds. And in 7 years from now, their balance sheet will have been reduced back to pre-COVID levels, which is still too high, but because we have 2008 assets, right? So anyway, so we'll get down the balance sheet by $5 trillion at the Fed. The problem is the U.S. government is not going to do anything about the negative consequences of their actions. So they gave away $5 trillion for free. So what they need to do is raise taxes, collect $5 trillion, pay off the debt, and then we're good. And inflation will go away because that Claudia money will be gone. So the Claudia money that created inflation will be gone, so inflation will be addressed. We know that ain't going to happen, and we're going to have persistently high inflation pretty much forever. Now, I'm not talking about 10, but we're not going to 2. Forget that. That's over. We killed it. We killed the golden goose. Okay? We're never going to get back to 2. See, inflation, interest rates are never going to go back to 1%. Never. Unless we reduce our debt. And we know that's never going to happen. So anyways, so that's the whole Claudia. That's why it's up on the headline there. What about some? The issue is if you're tracking this stuff, and maybe 0.5% of professional investors track this stuff. I'm tracking this stuff at my Council of Investment Advisors. We track it very closely. We have it all modeled out into the future. And it just so happens that today's non-farm payrolls has a very, 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 very big impact on the SOM rule, the model, today. And if we don't trigger the SOM today, we probably will never trigger it. But if we trigger it today, it tells a lot of people the United States is likely to go into recession. Now, very few people know about this. So for Commerce Bank to point it out is quite astute. It seems like they know that as well, but very, very, very few people are paying attention. They have no idea. I actually think the Fed is using it to whether they cut interest rates or not. So if we trigger the SOM rule today, the Fed's going to cut. And that's what they've been waiting for all along. All right. So anyways, let's get going. Holy crapola! Fundamentals, guys. We're doing fundies. We're 25 minutes away. That is massive, 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 massive. Okay? Massive. Joshua, off the top of my head, I don't remember the exact rules, but it's like the year-over-year unemployment rate relative to the change in the 3-month average, and whether it goes above or below the 0.5%, and it's a little bit complicated, but we have it all modeled out. The thing is, you can just, by the way, just go to the FRED, the Federal Reserve Economic Database, at the St. Louis Fed website, and pull up the SOM rule, and it'll all be graphed and charted out for you. This is why I went to the St. Louis Fed. It's the best Fed website out there because you can directly access their data. And it was something I did at Harvard all the time as part of being an econ student. So I love it. And so that's why I was in the St. Louis Fed a month and a half ago. Anyways, this is huge, and I kind of bet on that, and so that's another massive day. We're at 4.5, and now we're below 4. That is massive, which means we have a huge rally going on in the treasury market, and at the same time, the stock market is plunging, and that is right as rain. We haven't seen moves like this in a long time. Stock market down, bond market up. That is healthy. That's a healthy relationship. That's inversely correlated, and that's how it's supposed to be. So stock market down, yields down. Fantastic. Cool. And yeah, I think I have like 30% of my portfolio betting on that happening. And it's happening. Right? Cool. So that's telling us the Fed is going to cut. What this is telling us is the Fed is late. And if we trigger the SOM rule today, it's true. We are likely to go into recession, or we're already in recession. That's kind of what the SOM is going to tell us today or not, based on the NFP numbers. So wowzer. So this is the market saying the Fed is probably late. Cutting interest rates is too late. We're still going to go into a recession. Cool. Meanwhile, you should have bought treasuries when it was paying 5. That's when I got in at 5, and now it's below 4. Dude, that's a 20% up. Or in this case, down in yield, but presumably about the same to the upside. And that's great. Okay. Cool. Oil, I think, is near maybe a dipsy-do, but could be a buy again because of the geopolitical risk. But the White House told us today that Biden's going to fix that. Cool. So I guess that's down. But also, if this is collapsing and there's recession fear, maybe this overrides that geopolitical stuff. Like, oh, my God. Meanwhile, all of this is seasonal. So I don't know. What do you believe it is? It could be anything. Gold has had a bid now for about a week, where it was like for a month and a half it was up, and then for about 3 weeks it was down to sideways, down at 3,500, and then about a week and a half ago I put a little arrow on it to the upside, and so now we've gone from 23.5 back to 2,500, which is I guess about the the all-time high or near it, and so there could still be some up. Now, I said just the other day that would be an increase in aggregate demand. And you'd have to go back to that macroeconomics course where I showed you the long run aggregate supply. Well, you want to look at long run aggregate demand or short run aggregate demand and move those to understand what I'm talking about. But the forces are unclear right now, so I'm not sure. Because if this is coming down, that you would presume aggregate demand would be down and think gold would fall. But if it's coming down because we had high inflation, then it would be going up to hedge. But I don't think we're actually worried about inflation. So it's more like this is mixed. Oh, like this gauge? Yes. This is uncorrelated. And if these other things continue, this would probably be down by the end of the day. Euro dollar, yeah, modest. Bitcoin not going up. Hey, man, we were tickling 70 not long ago. Okay. Sell a commodity, 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 sell a commodity. Maybe commodities are risk off. Yeah. Let's take a look now at the risk gauges overall. We're going to look at 3 time frames, daily, weekly, monthly, and we're going to look at the entire options market. More than 1 billion options go into this. Okay. We're going to look at long-term treasury yields, short-term treasury yields, the stock market, the dollar, the yen, gold, and volatility. And looking at everything, there's no trend today. There's no trend this week. And if there was a trend, you could say risk off right now, but barely in the moment. So right now, you need to be more concerned about risk than aggressive about seeking your reward today. Now, you can't see this. This is like, looking at a telescope and seeing a black hole. You can't see a black hole. This is the underlying intrinsic trend looking at 8 constituencies over 3 time frames. So 24 observations of markets and time, and then looking at the normal correlation of risk, what happens to the S&P 500 in risk off periods versus 10-year notes that happen in risk off periods, and the options market, how do they get positioned, more puts or more calls, and by how much in risk off markets. Like, you have to understand the correlation of all these 24 variables, and you put it together, and right now you should be buying Swissy, buying yen, buying dollar, and selling Aussie, Euro, CAD. Well, we already looked at what's working right now. Sell Aussie, sell CAD, sell Kiwi. We've already known that. And you should be buying yen and buying dollar and buying Swiss franc. And if you didn't know that, you don't know. Okay? I'm not going to teach you about fiscal policy in the next 12 minutes because we have non-farm payrolls coming out. But just remember how it fits in. Okay, GDP, that's a D, okay, is equal to C plus I, come on mouse, I plus G, okay? Now, the way you should think about this, consumers, spending, businesses, spending, government, spending. So the simple part of this is you can fix it and just say the government comes out with a budget, and try not to laugh. They come out with a budget and they're going to spend the budget. It doesn't matter if the economy is good or bad. They're going to spend the budget completely and probably more, but we won't talk about that. We'll just say there is a budget and they will spend every penny. So that's fiscal policy. So next year, if they increase the budget, it will increase GDP or offset declines in consumption. And that's what it's supposed to do. Okay? So if you go back to Keynes versus Hayek, but Keynes would say if consumption is falling and business investment is falling because we're in a recession, the government should increase GDP or increase government spending to offset the declines, create the demand, and rebuild consumption and investment, and therefore save GDP. And then when GDP is hot and because of hot consumption, which we have now, they should be paying down their debt. Well, we have a 2.8 GDP, heavily influenced by a massive consumption spending, and yet the government is not raising taxes and paying down the debt. So it's a massive failure, according to Keynesian economics theory. All right. So we got to keep moving, guys. We got a lot to do. So that's the long run. You need to be very, very, very careful today. What's happening right this second? This is like not long-term stuff. This is what's happening now. Scatter plot mostly looks this way with some outliers to the upside. So EuroCAD is up a little bit, but QuantBox, this is QuantBox inside of TradeRs. So TradeRs, economically speaking, when you look at the positive score, it's assuming up, and right now it's up a little bit. This is up. So, and everything to the right is supposed to be making money today, and everything to the left is supposed to be losing money today. And, it's mostly out of position. Okay, it's mostly out of position with a few things doing okay, but I'm going to count those as outliers. Silver is up. That makes sense to QuantBox. Gold is up. That makes sense. But most things are kind of bullish and unexpected, bearish, but not by much either. Not by much. Well, this is probably money coming out of the market right before an event, a risk event. So this is right as rain. You would assume something like this right before non-farm payrolls, and maybe by the end of the day, things organize themselves. If we find, okay, today is actually unique. Let's talk about non-farm payrolls for a second. Let me get off my normal process. When I go to fundamentals and I go into employment and then I go to non-farm payrolls, let me show you non-farm payrolls. Okay, this was updated just recently. All right, great. So, the thing is, up until now, over the last 12 non-farm payrolls, we wanted to see a slowing down in non-farm payrolls. And at one point we had a 5er, and then we dropped to, the high 3s, and then we started printing 2s or lower. We're still in the 2s. We probably want to see like a $1.80 and stuff. So generally this was trending towards the Fed could cut. Now we're at the point where the Fed has basically told us they're seriously thinking about cutting in September. We're in a different situation here because if it's too low, then people are going to freak out that the Fed's late and we're in recession. Right now, we are already in recession. And that's indicated by all the bad or disappointing earnings that have been coming out this week and last week. And so people are going to go, oh, God, the Fed's late. We're already in recession. So how's Bell? So I don't know. Like before we were hoping for a low number. Well, now I'm like, well, maybe we want a higher number. But you can argue if it's too high, then we don't trigger the SOM rule. And then the Fed says, well, we're still not ready. We're close, but we're not ready. But the problem with that is because of my research, Council Investment Advisors, and by mine, I mean Joseph Urban's, but his good work on our model suggests if we don't trigger it today, we probably will never trigger it, which would be a signal that the Fed never cuts. Well, at least wouldn't need to cut because of a recession, so we never go into recession. So it's like it's a toss-up, like how people are going to read it. In particular, institutional investors that know. Retail traders don't know anything like this. They're just in the way. They get run over. So anyway, so maybe just a good old 206 would be fine. Not low, not high. And I think we want to trigger the SOM, but not to the point where other people make the same conclusion. See, we just want the Fed to cut. And if 97, 98, 99% of the market doesn't know anything about the SOM rule, then they're not watching it. So we want the Fed to get the SOM rule triggered to say cut, so they cut. Meanwhile, everyone else is like, okay, good, we're not going to go into recession because they're just guessing. Okay, cool. The other thing we're kind of looking at a little bit is wages, because that's where our inflation is coming from. And wages have been steadily falling with a median of 4.4. If we just look back instead of 1 year, if we look back, let's go just the 3-month average, maybe. Oh, I thought we fixed this one. This one for some reason I can't manipulate. Ugh, I thought I fixed that. So anyways, I was trying to get the 3-month average, but you can see the 3-month average is falling. And this probably is one major reason that the Fed feels confident that inflation is falling, because now we're below the 4 handle. And at one point we're pushing 6. Okay. Cool. So anyway, so that's kind of going in our direction here. If you want to look at job openings, okay, JOLTS was a bit surprising, huh? 8.18. That's 3 months of up again. This tells us we're probably not going in the recession, okay? Companies are advertising again. Look, we've been falling and falling and falling and falling, but now we're up 3 months in a row. So that's worrisome to the Fed. If we go to claims, so we had claims yesterday, and what this is expected in gray. So last week we expected to get 236, but what actually came out was 249. Okay, so good. That allows the Fed to cut. And the revision last week, okay, 2 weeks ago, we thought it'd come out 237. Okay, it came out 235, and it wasn't revised. Okay, and that's above the average. It's okay. Like, we're getting there, right? Okay, so, you know, we're getting there for sure. Okay, what do you guys want to trade today when the news comes out? What currency pair? Or what asset? Okay, S&P, yen. Well, Sandeep, isn't the dollar strong right now? Why would you trade dollar yen if yen is strong and dollar is strong? Gold, really? Okay, that's another odd one. Silver, again, probably not the best thing to be looking at. But I guess we can look at it later, but not on the news. Oh, my microwave says 823. Okay, you guys are trading gold and silver at the wrong time. What I just went through, you should probably see and go, okay, that doesn't make any sense. You should probably be doing something else. But okay, euro dollar, you know, and so we can just pick that up very quickly. Okay. All right. So you can see July to August, euro dollar on the 20-year average and 5-year average falls. Did you know that? Yeah, Abdullah wants some signals for gold. Cool. Send me at least $1 million and I will do it for you. At least. But somebody offered me $1 million last weekend and I said no. So at least. But if you need someone to make those decisions, I'm qualified. All right. So anyways, did you know that? July to August to September, euro dollar on the 20-year average and the 5-year average has consistently fallen. So yeah, euro dollar down. If you didn't know that, you're getting run over. By the way, here's the thing. I just tested you. I just showed you some of the major assets you should be buying and selling, and nobody answered it correctly. For shame. I just gave you the answer. And you're like, I don't know how to organize my thoughts. Well, you can organize them this way. And there you go. Very bullish, bullish, neutral, bearish, and very bearish. Okay, what's the problem? You just have to incorporate interest rates, jobs, inflation, GDP, technical trend, seasonality, retail positioning, institutional positioning, and then do a comparative analysis of all these different assets to each other and score them. Okay? If you're not doing stuff like this, you're amateur. Just so you know that there's somebody else that you're competing against and they're more prepared than you. That's brutal, right? But, you know, many of you said gold. I get it. You trade gold every day because it's your thing. That's not the right way to trade, but I know that's what you do. So, you know, we can do this technically. And so let me answer that without an opinion. I can do statistical analysis of the price time data in gold. And in, right, in 7 days, we can get this up to about 27.5. Best case scenario, worst case scenario, we kind of just drop and head back to where we are and move sideways. Base case gets us to, I can't see that. Can you see it? 25.85 in the next 7 days. Done. You should know that. Or you'll look at it fundamentally. when people say, what do you think about gold? This is what I think about gold. Okay, I know everything about gold. So I'm moderately bullish on gold. And there's my projection 7 days in advance. Here's why. Here's why. Here's why. And here's the seasonal averages over the last 10 years. I am frickin' informed. So you will be able to pay for this. How about that? So I need to move over because we're going to do something new today that I haven't done in about 10 years. So 10 years ago, I used to have a relationship with a company called TradeTheNews.com that had live squawk. Okay. Well, I may be developing a new relationship. And don't worry, this is not like an affiliate program. I'm trying to promote this and earn $20 or something. No, that's not right. But I'm interested in maybe having a squawk relationship again, which means you pay for a site license, right? And the CEO gave me permission today and over the next few months to use their new squawk around non-farm payrolls, which is coming out in probably about 90 seconds or so. And I'm going to use their squawk to get the number out quickly. Okay, so I'm going to turn it on and then get ready. And I think I'll just trade euro dollar. I think everybody's into that, so let's do it. About what, a minute? Yeah, I think about a minute. Okay. Notice that I had this set up like a range. We're just selling to the bottom of the range. There's no prediction here. It's just rangy. See? So the idea is you sell to the top, you go to the bottom, buy at the bottom, go to the top.
So just 1 minute now on that US non-farm payrolls release. Again, the headline that's forecast at 175,000. I'll then move on to the unemployment rate, the revision to the previous, then run through the earnings metrics, labour force participation rate, the private, manufacturing, government, 2-month, and death.
So I want jobs up and wages down, but that doesn't make any sense, but that would be great. In fact, and I don't want 275, let's make it $190 or 200,000. That'd be good. It's not bad. It's not good. It doesn't point to recession, but it still is low enough to maybe allow the Fed to cut. So I'm hoping for like 190, 192, something like that.
10 seconds.
10 seconds. Ooh. Let's go, Bubba.
114,000, that's 114,000, that's a missing expected 175,000. Unemployment rate unexpectedly rises to 4.3% from 4.1%. The private was revised low to 179,000. Average earnings month to month at 0.2%.
All right, we triggered the song, man. Oh my God.
Year 3.6, cooler than expected 3.7.
What about unemployment?
Expectedly falls to 34.2. The participation rate rising to 62.7 from 62.6. Private, that's 97,000, below the expected 148,000. Manufacturing, 1,000, above
Revised.
the expected minus 1,000. Government payroll, 17,000, against a previously revised at 43,000. Just to go over the bones of that report then. So for the non-farm payrolls, that was a miss on expectations.
The revision was down.
Previous. We saw an unexpected jump in the unemployment rate to 4.3%.
4.3! Oh my God!
Than expected.
4.3 is massive. Oh, that's dirty. We're in recession. Oh my God, we're in recession. That's gotta trigger the SOM rule, man. We're in recession right now. Wow. So the reaction here by the market, remember, they don't know the SOM rule. They don't know jack. Okay. So what they
Just
say
in
here,
terms of the pricing reaction here,
hang on.
we're seeing around 108 basis points of these.
All right, he's talking over me, and now I'm going to stop him, and I might bring him back. So what's happening here is the market reaction is the Fed has to cut now. They have to. They're definitely 100% going to cut in September. Now, the smarter money, though, is like, oh, shoot, we're already in recession. And so now the Fed is going to need to cut, not just to normalize, but things are going to get worse and worse and worse. And who knows? Maybe next year's a bad year because of that, right? Yeah, but that's what the insiders, those that know, are able to predict the recession 3 and 6 months before the recession is hit and been identified. And those who don't know are just kind of late. So look, nobody knows the future. But based on the mathematical models of some, and the more modern models versus the more traditional models, it would point to that we already entered the recession. And so when you look at the earnings by Microsoft and Google and Amazon and stuff, they were disappointing. And those numbers came from 3 months ago. And so the lagging variable effects are just starting to be seen in places. And one of the models that I use would probably be triggered as, guess what, bro, you're already in recession. Now, this is months and months and months, maybe even 6 months, 9 months before the traditional model. So like the traditional model, for example, would be 2 quarters in a row of negative GDP. We just printed 2.8, okay? But that's the quick and dirty guesswork one. Then it has to be revised. So it'll be revised down. And then we got to wait 3 months. And then we'll find out in that one that maybe it's a negative GDP. And then you got to wait 3 months again and get the new GDP, which would be negative. And so in that case, 9 months from now, by definition, we'll be in recession. But if you knew today we were in recession, 9 months before everybody else is even talking about it, you can position your portfolio properly. Now, again, I don't know the future, but I know that there's probably 0.5%. So 95.5% of Wall Street probably doesn't do this stuff. But I do at my Council of Investment Advisors. We've been watching this model every month since November. And we knew the Fed wasn't going to cut in January. We knew they weren't going to cut in March. We knew these things because, well, we have a model. Now, almost certainly the model says the Fed has to cut now. And my guess is the Fed's been watching this model too. So now that they just triggered the SOM, they're probably going to cut. Great. But everybody, that first response, a giant green candle, says, everything is awesome. Yeah, but be careful. Okay, I don't disagree with that. That means there's a Fed cut coming. But if more people get wind of this, over the next 2 or 3 weeks, they might say, wait, the Fed's not cutting to normalize. The Fed is cutting to respond to a recession. So one of them is good and one of them is bad. Which one is it? Well, that's for the market to decide. But the model would suggest it's bad, not good. And euro dollar going up is a risk on play. Okay? It's a risk on play. What do you think of the squawk? Pretty nice, wasn't it? That's right. Airbender says, hey, that means strong dollar, right? Yeah, but obviously we see it's not now. Most people don't know this. So, Charlie, we're not trying to outsmart the market. That's not my goal. But I do want to understand why things are happening or what could be happening. I need to be aware. I need to be prepared. Because remember, like I said before, I don't predict anything, but I prepare. So if I understand what let's say the top 1% are thinking on the long term, I can be ready, willing, and able and start looking for those changes in the market. If the rest of the market starts to learn this or be fed the narrative through whatever source, and they change their mind, then I can observe that in the market and then go along with them. I don't want to say this green arrow's wrong, so I'm going to short it. I'm going to short against the green arrow. I never think that way. But when it went up, I explained instantly why it doesn't make sense. There's a difference. Okay? Now, if you're going to scalp, the way I've taught you at FX Street and in my book and in my training course, if you're going to do a high volatility event-driven strategy, that's why I drew this. You need to be ready to buy this, like now, like you may have already missed it. And that's it. If you can't do that, it's not a scalp. Now, I understand, like, on the long run, I actually think this should fall. But on the short run, okay, it's a definitely maybe up. Okay? So, do you guys want to try to go along? Let's have some fun. All right, we'll go along. Okay, and then you can put your stop down here. We'll put it there. Okay, and that's just a scalp. There's no bias. There's no additional analysis. All we did is we measured the spike. Okay, and that could tell us or indicate. Okay, that would indicate that the market's response to unemployment going to 4.3 or headline non-farm payrolls being way significantly lower, and last month being revised lower, that the Fed is going to look at all of this data and they're definitely going to cut interest rates in September. Okay, that's all that means. That giant green candle. This is in my book. This is in an article I wrote probably 8 years ago at FX Street. This is something I've trained for 220 months in a row. I'm not doing anything unique here. It's just a scalp. There's nothing smart or clever about it. It's just a technical trade, right? So you have the up, and I don't buy high. So the green candle only tells me buy. Because the assumption here is that we will get a continuation out of this. So you get the up, stay calm, and you're assuming a down somewhere between these lines. You want to go long. Now, which line you say? I don't know. You could wait for the price action, or you look left and find let's say an old high, and you use the old support as resistance, right? Or you just blindly buy it at the 50%, or you buy it off of a moving average, or you buy it off a psych level like 108.50. It doesn't matter. Wherever you buy it, your stop's just going to be below the lowest low. So I'm risking 25. How much should I make to feel like a real man? 25 OCO? A 1 for 1? Or how about a 2 for 1? Am I a real man to get a 2 to 1? Okay. 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 I'm going to put it here because one of my little rules here is a 618 predicts a 1382. So we'll just leave it at that. I could get out at 121.4, but I'm just going to leave it there. It's pretty. All right, so here's my trade plan. Okay. I bought at the 618, but because of the spread, the entry's at the 50%. Okay. And the target is 1382. So David's like the intraday trend line and blah, blah, blah. It's just a high volatility event-driven strategy. It's not based on trend. It's not based on fundamentals. It's not based on a channel or a Gartley. It's just a vol trade. I'm trading the vol. Okay? On the scope of reality, it's nothing. It's a worthless, dumb trade. Who cares? But it's vol. I don't think anything of it. It's nothing to me. Okay? All right, cool. But normally, here's where I think things are going to get interesting. Normally, dollar weakness is risk on, and I'm not convinced that that's what's happening. So I need to, I need to be, I need to have clarity of mind. Okay. So it's an interesting number. Oh, for sure. But the interpretation here of risk on, I think, could be wrong. And I'm okay with that. I'm a lumberjack and I'm okay. I work all night and I sleep all day. I cut down trees, I kill wildfires, I wear high heels and a bra. Okay, all right. So that's that. Whatever. Yeah, so people are like, what else? Yeah, Denise, did you know that about Canadian lumberjacks? All right, look at that. Brutal. So this plan failed, obviously. This was from last night. And, I want you to look at this. And if you say, oh, well, he was wrong on that, you're not thinking about trading properly. Okay? There's no wrong and there's no right. There's not even a good trade or a bad trade. I mean, you can have a bad trade if it sucks, like you just threw down a trade, or there's no fundamentals behind it, or your technicals just don't make any sense. Like many of you are like, what about this thing? And I'm like, dude, I just showed you the 8 best currency pairs to trade, and none of you want to look at it. Like that, all of a sudden, that's the part I don't understand. Like I even just showed you. And you're like, I want to trade silver. What the heck? I just showed you, based on quantitative analysis, the 8 best things to look at for trading, and you don't want to even do it. Oh my gosh. Well, I like trading silver all day, every day. Right? I'm like, what? So anyways, don't look at this like a failure. You know what this is? A plan. And imagine now, every single trade you make, you're going to make 5,000 trades in the next 365 days. Now imagine every single one of them was planned out in advance. No mediocrity at all. Now, you're going to have failures, but imagine every single one of them makes sense because you planned them in advance, technically and fundamentally. Okay? All right. So, this plan set just last night, okay, was, hey, look, we recognize we're at the bottom of a channel. Okay? And then this upward move, oh, my mouse is struggling. This upward move is geopolitical risk. Okay? And even then, it just gets to the top of the channel, then it dropped to the bottom of the channel. And there's some rationale to the idea that that geopolitical risk might return. That makes sense to me. So you would, at this price, which we were at last night, between now and London Open, if not New York Open, you would expect to see some up. And because this is an M2, well, the long run, we should get up to an M4. That just technically makes sense. And that's assuming increase geopolitical risk, a breakout to the upside, and then, that kind of stuff, right? It's just a plan, just a trade plan. You know the price and the time, okay? You know the time is probably London Open, and you know what the price is. It's all there. And so if you took that trade because we got a higher high, higher low down here, well, then you know your plan is this way, right? Cool. So you are in total control. What happened London Open? We did not get the breakout. It's a failed trade plan, but it doesn't make you a failure.
On the geopolitical front, according to Al Arabia, citing American officials, Washington preparing to send additional fighters to the Middle East.
Okay. So it never happened. That's good. That's good analysis. Now imagine you did that 5,000 times a year. You're going to miss some. Some of them are not going to work out. But I bet you, with solid fundamental and technical analysis. Okay? And so you want to do things like this. Let me bring this back. Okay. Okay, gold. We're at 25. It's up today. And we have a 6 on the score because we looked at institutional positioning, retail positioning, seasonality, the technical trend, GDP, manufacturing, services, retail, inflation, the change in employment, the unemployment rate, and interest rates. And this is the change since yesterday, a big change, or the recent change. So it just popped 5. It went from 1 to 5 just in the last few hours. Holy schnicker-schnacker. So you have permission to engage in the upside. And this is the score. This is the change in the score. And this is where the score is coming from. Okay? All right. So let's get into it. So you have permission to buy gold if that's what you want. So now you can go to gold. We'll do it this way. Okay? And it doesn't mean to buy, it means you could buy. So you would do something like, this is how I teach people, right? You leave love notes to yourself. Okay? QB is equal to 6. It's moderately strong. Now, here's what I did for subscribers. Okay, many days ago, 1, 2, 3, 4, 5, 6, 7, 8, 9, about 10 days ago, I put a little pink arrow there after the breakout in the moving averages. Gone. About to make an all-time high. And now our score has gone from 1 to 6. Okay. Burned, I'm just going to say, you're thinking the right way, but you have to remember there's demand destruction probably for months before you get to the point where we're rebuilding. And at that point, you need some sort of fiscal or monetary response to the new crisis. So yes, but it'll probably take months before it actually kicks in the way that you're saying. Okay, so if we are going into a recession, oil would drop like a ton of bricks. And burned, and I think that's what you're meaning. I was just showing you yesterday what the point of that oil trade setup was. And it wasn't wrong, it just didn't work out that way. My point is, if you put together a plan, just be bull or a bear. Just don't be in the middle. And so if you're like, okay, in general, I'm bullish on energy. I know the market's falling. but now falling but moving sideways. And I know the reason it stopped falling was geopolitical risk. And my assumption is that maybe there's some more geopolitical risk. But, not only is Biden going to solve Venezuelan election problems, he also indicated last night he's going to fix the problems in Israel, and not just his war with, the new war with Hezbollah and Hamas. So now Biden's going to fix all that, right? So geopolitical tensions go away, ceasefire gets done, oil collapses because the geopolitical risk is now gone. Okay, great, but I didn't know any of that yesterday, right? So it's just like, look, how do you be a successful trader? Outsmarting the market all the time, in particular as a retail trader, is just a fool's errand. So all you can do is be on one team or the other. Just be a bull or a bear. Okay? And so if I was a bull trading a continuation of a geopolitical risk, well, in that sideways market, I'm going to play it like a sideways market. I buy at support and rotate it up back to resistance and maybe beyond. So how would I do that? And then I set it all up technically, and I have a generalized idea of the price. I don't know the time, but I can guess either Asia Open, London Open, New York Open. And when it occurred at the London Open, instead of going up, it collapsed, failed trade, walk. Take a walk. Now, honestly, if I was a bear, that would have been a dumb trade anyways. What kind of loser sells at support? Because it was clearly support. I was set up to maybe buy it if the rest of the market wanted to be bullish. I would buy it at support. So the loser that sold it really is probably just on a daily chart or a weekly chart. So they have a much longer term view, or maybe they're not using charts at all. It's pure fundamental. And they say, oh, well, the likelihood of a ceasefire now, because of Joe Biden picking up the phone and having a stern conversation with Netanyahu. Okay, Biden created peace in the Middle East, whatever, and oil falls. Well, that makes sense too, but that wasn't in my trade plan. And I wouldn't have agreed with that technically, but fundamentally I understand it. The thing is, if you trade your technicals properly and you have a strong fundamental bias, you know when you're wrong. And when you're wrong, you almost never get trade setups, technically, on smaller time frames. It never turned bullish. So even though we wanted to buy at that support, and London Open didn't give you the opportunity, and sure as anything, oil collapsed because people did not buy it. In fact, people probably just got out of the long. So that big red candle on oil isn't necessarily people selling. It's bulls like me either not getting in, or people got in and got out, or people just said, you know what, I capitulate. I bought oil 6 months ago. Now it looks like it's just going to fall all summer. So they just get out. But it's probably more people getting out of oil than people selling. Okay? That's a lot, bro. Anyways, yeah, so check that out. Here is the up. And so, you know, if you're on my team, you would have been long 10 days ago. Everyone else is now chasing the news after non-farm payrolls. Okay. More to life than that. Now, to add to it, we have this cool thing called radars. So we're a 6 on gold. Do we see anything technically happening? Okay. And one of the things you could do is you could say, okay, go to commodities. Hey, traders, go to commodities. And let's just narrow things down and say commodities. Don't tell me anything about Brent. Don't tell me anything about WTI. Don't tell me anything about silver. Just talk to me about gold. Do you see any patterns? And it says yes, on the 30-minute, on the 15-minute, on the 60-minute, and on the daily. On the daily, we are in a rising wedge and heading on up to at least 2,500. You're like, Wayne, we broke 2,500. today. Oh, you're right. But you were told 2 days ago. I told you 10 days ago, but this is just a rising wedge. So you would have known 2 days ago to set this up, and you're probably like $100 in profit now in gold. Probably, or on the way. Okay? And of course, if you stick with it, remember, and I want to make this a point, I hate alert services. I think they're the dumbest thing. I really have. And I've always felt this way. Okay? If you sign up for an alert service, you're a sucker. They're going to make you $1 million a year, but all you have to do is pay $50. Come on, dude. That doesn't even make sense. Okay? The second thing is, why would I treat you like you're stupid? Okay? So, am I a bull or a bear on gold? Does anybody know? The fundamental analysis of gold now inside of Tradars tells me I'm a 6. I'm an M bull. I'm moderately bullish. Why? Because of some weird algo? No, quantitative analysis of macroeconomic data. Like legit. You understand? Legit. Okay? Like MC Hammer legit, right? All right. So when we have legitimate data, we only look for buying opportunities. But we only look for buying opportunities in an uptrend. And this is just showing you that we were here 2 days ago. You should have bought down there. And the next pattern is up. That's good. Now, tomorrow, you'll probably see Tradar say, oh, down. Does that mean sell? No. The most important data here is it's a rising wedge, yo. It's an uptrend, bro. What kind of knucklehead would sell an uptrend? Well, you're a bull, which means you think it's going to go up. You're a bear, which means you believe it's going to go down. Or you're a bat. And a bat is an acronym. You're either bullish and you buy low. So when you're a bull, you buy down here. And then it's going to go up, and then it's going to fall, and then you buy it again here. You never sell. If you're a bull, you never sell. Ever. Oh, well, the machine said sell. No, it said the next wave in the pattern is down. And then the next wave after that is up, bro. You understand? So if you're a bat, you buy and sell without prejudice. You don't know anything that's going on. You're a dog chasing its tail. But in this case, you're a bat, a broke-ass trader. You add no value to the market. You're just in the way. You're stepping on everyone's toes and you smell bad. People are like, you should probably just leave the party. You're not cool. Okay? So when you dance, it's a symbiotic relationship. Okay? So when men and women are paired in dancing, one person's left foot forward is the other person's right foot back. And when you do that and move to the music, it's beautiful. But if you're stepping on everyone's toes and you're stinky, nobody wants to be around you, right? You're just in the way. And that would be like, this says down and it has a down arrow. Broke ass trader. If you saw an up channel and you saw that to sell, you don't know what's going on, bro. You're I don't know what planet you're on. Okay? So look, so down, down, down. All right, down, down, up. So that means sell, right? No, it doesn't. That means sell, right? Do you even see the channel? Are you even looking? Are you even thinking about it? This is up. What do you see? Right?
Just know for NVDA, NVIDIA, negative opinion from folks at Elliott. Elliott says NVIDIA is in a bubble. AI is overhyped, according to the Financial Times.
Oh yeah, whatever. That nonsense just means they're trying to sell newspapers. All right, let me turn the squawk off. Okay. But like, oh, but it drew an arrow down. It's telling you the next move in an upward channel is down. The next move in an upward channel is down. Now, the 15 and 30 very often have the same channel, right? Yeah, it's the same channel. That channel is up. You're a bull. You only buy low. If you don't know that level of detail of trading, you don't know anything about trading, right? So then you look at the higher time frame and it's clearly up. But we need some down. Left foot forward, right foot back. So bulls actually need it to come down so they can buy some more low and drive it up. And then it'll hit high. So does this, when you get to this price, does it mean sell? No. It means expect a dip and then buy some more. So you have to like have, you know, come on, a small level of thinking. So when I originally launched TradeRs, some of the early adopters sent me emails and like, I quit because these are all wrong. I'm like, what do you mean they're all wrong? These are all trade plans. They're perfect technical analysis. And they're like, it told me to sell and I lost my, I couldn't make my $100 a month. I couldn't make my $80 a month. So I'm out. I'm like, dude, you don't know jack. You don't know jack. You thought that meant sell? You didn't even think a little bit. That doesn't bode well for anything else in your life. A little bit of common sense says, this is a downward move in an up channel. Okay, like at least a little common sense, right? So anyway, so that's another reason why I'm bringing QuantBox in, because then I realized, well, maybe they just really truly don't know what they're doing, and they were hoping that this would make them decisions and make them rich. But see, I don't understand that mindset. I really don't. But you know, I don't have empathy. So, but I thought if QuantBox said, hey, dude, based on fundamental analysis, bro, this is a +6, you should be a buyer. And then hopefully if I put together a training course for you, you know, little things like if you're a bull, you buy higher lows in upwardly moving channels. Do you think I could do something like that for you? Put together a training course to say you buy dips if you're a bull? Now, I'll find a way to make it 6 hours, 7 hours, 8 hours long. I'll do it in great detail. But how many people understand the concept of if you're a bull, you look for bullish price action of higher highs and higher lows. And when you spot that, you buy the higher lows. Does anybody how many people understand that concept? Okay? That when you see this selling here is not the best strategy. Okay? So you have to decide. Now, could you do it? I suppose you could. I don't. So where should we buy? Well, how about here? Okay. So when you start with the fundamentals, and remember, I showed you that first. Okay. So 10 days ago, I actually went long, or showed you how to go long on this account. And so therefore, you would be, every time you're looking at your charts, you could be looking for the opportunities. Now, this is how you're supposed to do things. So I have to rewire everyone's brains, I think. And it's okay. It's okay. I'm not complaining. But I learned a lot because some of the people that signed up have been with me for a long time. So I just, I assume, like, all right, Traders is going to do a whole bunch of work for you. And then they open it up and they're like, it says sell. I'm like, oh my God. And I just melted. I mean, when you think years of my work and they look at this and then they're like, it says sell. It's so funny. I never saw it that way. And so I'm glad we did this. And it showed me that I have to bring fundamentals in and I have to teach more. And it's more like when what this is saying is, yes, in the next 7 hours, and by the way, this just came out about an hour ago. So we were up here. In about 7 hours, so by the end of the day, there's a chance that gold could come back down to, down here somewhere. And if that happens, I should probably get ready to buy. And that would go to the up to the channel. I mean, I never looked at it any different. You see? Well, that's different. So this is, Grumpy Cat, this is doing the grunt work for you, but it's not doing the work for you. I'm trying to get it down so that, like, the fundamental side of traders is giving you a target list of 5 to 10 things to watch today. And it can prove why. With so many variables now, and it's so sensitive now compared to 2 years ago when I launched it, it's really incredible. Gold went from a 1 to a 6 today. Oh, snap. That used to take weeks, and now it's very sensitive. But it gets you focused on the right things at the right reason, or at the right time for the right reason, and you can go back and figure out what the reasons are. It showed you all the changes and why suddenly it's much more bullish, and you're like, oh, that's cool, okay? So you really know what's going on. So then you go, okay, well, are there any reliable technical patterns? And these up channels, right? Up channels, those are reliable. Rising wedges are reliable. Look at some of these channels on different time frames. So it's watching gold for you on 4 time frames. Cool. It's doing grunt work. And it's just like, hey, Grumpy Cat, it's going to fall here in this up channel. So, when you get down to, I don't know, 24.5, look for some up, because this is an up channel and that's support. And you're interested, Grumpy Cat, in buying at support. If you look at a different time frame, it gives you about the same number. This is already in the move on the longer run, and it's supported on the daily. So this came out 2 days ago. This came out 5 hours ago. This came out 1 hour ago. So you see, it's been stacking them on time frames, right? Which is just another way of saying, yeah, there's something interesting going on. So then, Grumpy Cat, you say, okay, well, my number is somewhere around 24.50-ish. I should get ready, down to, I think it said 24.40. So somewhere in that zone, I don't know, somewhere around there, you should be ready to buy a dip. So now you open your gold chart. Yeah, you see? You see? Now you open your gold chart and you're like, okay, do you want to scalp this? Do you want to spot it? Do you want to swing it? Do you want to carry it? Those are all different time frames. You can use different indicators. Are you going to use oscillators? Are you going to use pivot points? Are you going to use price action? Are you going to use moving averages? Are you going to use RSI, Stokes, MACD? Are you an Elliott wave person? At this point, it doesn't really matter. I really don't care. But a generalized price, but you don't know if it's going to do it, or if it does it, when it's going to do it. Well, that's price and time. You just describe technical analysis. Okay? So I don't want to mess with this. Let's pull it up somewhere else. Do I have it? I think I have this somewhere else, don't I? Metals. I don't want to mess with that chart because I spent some time on that. XAU. Okay, so let's clean this up a little bit. We can template. Let's look at monthly here. Okay, nice and clean. Okay, we're a bull. So you might say bearishness, like you might say, Wayne, but it might. That's so funny, right? But it might do this. Yeah, it might. Are you a bull? Yes. Can you tell me 6 or 7 reasons why you're a bull? QuantBox does. Oh, okay. We don't know if it's true, but you have evidence-based strategy. It still doesn't predict the future. It just tells you what is right now, and QuantBox can go into the past, and then based on statistical analysis, do a linear projection forward, but it's not a prediction, it's a linear projection. Okay? So there's a lot, right? And so 7 days say we could probably get to here. But you're right. If this was going to turn bearish, oh yeah, it'd probably do somewhere around here, correct? But that's the bearishness we need for our bullishness. Okay, so we had sort of a zone, didn't we? I'll put this up here, and Tradar said, hey, watch 2440. Didn't type that in, obviously. Let's do it. This time I'll try to look at it. Horizontal. Okay, 2,440. Okay, 2. Okay, I'm just doing, you wouldn't do it this way. It's too slow. I'm just showing you what we did on the technical side. Okay. So we said, and let's drop into a smaller time frame now. If price kind of gets down into this zone, and then you see some technical analysis that suggests up, you take it and you hold it. Now, the question is, okay, those are, okay, bigger pivots. What about smaller pivots? Yeah. So we can do that if you want. And in fact, let's do it a different way. Daily confluence bullish. Now that we got a lot of things going on here. Okay. So what does this say? This says, the way I teach my training courses is this. This green zone was today's buy zone. Today's take profit zone is right there. It didn't even go a penny above my target. You're welcome. And then it said, today you will buy at 24.57, which is about what Tradar said technically as well. And there's today's target for, or I say today, that's Monday. That's Monday's buy zone and Monday's target, which puts me into the Tradar's trend, and I'm golden. And I knew all of this today. Like, this isn't new news. So like if I zoom in maybe on an hourly chart and zoom in even more, if I can get it, I want to show you that yesterday, okay, I'm talking about when we were here yesterday, we already knew that this was today's buy zone. And today's buy zone has 2 levels, a conservative target, which was drawn when we were here. Here, you are here. You already knew that this was the buying zone. That's the conservative target, and that is the aggressive target. Huh. Well, hell's bells, that's a little bit accurate. Well, let me show you like the basics of trading. Because we did it here, we did it there. Look at buy here, conservative target, right? Okay, let's go back to yesterday, messy day. Okay, well, the day before, we ended up higher high. Teach me how to trade. You buy the higher low. Where? I don't know. How about the green zone? Sounds good to me. Higher high. What do I do now? Buy the higher low. Where? How about the green zone? Higher high. Oh, great. So now what? Where do I, right? Now I need to buy a higher low. Where? I don't know. How about somewhere around here? And what might happen? Well, I might make a higher high. And then what will I do? I'll buy a higher low. So like, for example, you could argue that you're already in Monday's trade. You have a 6 on the fundamentals. You have 3 time frames say buy a dip. 4 time frames that say buy a dip. And now you go to a chart and make a decision. Okay? Okay? Can you see the level of detail you can have in your trade planning now? You see? Isn't that wonderful? Imagine every trade you made was that hardcore. But of course, now you can do it very quickly. And now I hope that brings you the confidence to let your winners run. Let's go check out the vol of that news, because I think there could be some crazy vol on this, right? So we go to our euro dollar, and my scalp is successful. Let's go back to the 1 minute. Look at that. Look at that, where that bottomed out there. Look at that. What do you guys think? Nice, easy scalp. You see how calm I was, by the way? I mean, I wasn't calm on the green candle because of the shock of the news, but I didn't freak out about the trade. It came down. Remember, I bought it right here. Can anybody confirm, for those that just logged in? We just ever so effortlessly bought it here. Ever so effortlessly. Said it's just a scalp. That's where we're going to get out. Just boring. I want you to know if trading is exciting for you, you're doing it wrong. Okay. And do you know that I've taught this for 220 months, which is 18.5 years? Okay. Yeah. Crazy, right? That's why I want to be, like, when you're prepared, you remove the excitement out, because when you do something like place a trade, you expect it to make money. It's surprising when you don't. Now, you always get in those situations, but you're like, but that's the surprise. You're like, oh, why did it go up and not down? That's weird. And usually those situations, you're not in it. It doesn't mean you've lost money. You never got an entry. So you want to get to the point where most of your losing trades are not losses financially. Your losing trade is actually just a failed plan that never gave you an opportunity, like that oil trade I showed you. If it was going to turn bearish last night, we would have made money and been able to hold on to that trade for a long time, because we have the confidence, because we've already done the analysis technically and fundamentally. Totally makes sense, totally get it. But it didn't price in peace in the Middle East. it priced in continuation of geopolitical risk. So if that geopolitical risk is removed from the equation, oil comes down because other people priced it in like we did. The thing is, we never got an up trade. So it's a failed plan, not a loss of money. And you just walk and, reanalyze. And, like when you bring up traders, if we bring up like this one, we regroup and say, okay, maybe something's changed. Okay, maybe something's changed. So we go to like a scorecard and you're like, let's go to industrial commodities, and we have it on oil. And like, did things change? No, we're actually fundamentally neutral. Okay. You see? So, and what does it say technically? Well, it says down. So our up opportunity has failed, and our 7-day projection is it's coming down below 73. If you're a bear, that's best case scenario. Okay, 73, 72, 70. Now, you can get a better look at it if you want to go here and say, hey, traders, please project 7 days into the future using statistical analysis. And please do that for U.S. oil. Cool. We were at 83. We broke below the 20-day moving average, and it's acting as resistance. Our base case is 73. Red and trend. Is that right? Hang on. The gray one. Oh, there we go. 75.22. Our base case for the next 7 days is oil falls to 75.22. It can fall as much as 72.69 or kind of rise and then fall back down to 77. So there's our 7-day projection, not bullish. So you don't have to ask me, hey, Wayne, is oil going to fall? Well, why don't you do some statistical analysis? Just pull it up. You don't have to ask me anymore. Okay? This is not guessing. This is statistical analysis of price time data. Okay? This is the math you learned in 7th grade. Okay? Oh, and by the way, we have this for everything. Well, what about silver? What about the Russell 2000? Oh, yeah. What about pound CAD, Wayne? Do you have pound CAD? Oh, snap. He's got everything. Uh-huh. Good to know. So the thing is, if I know, but you don't know, who's more likely to win, huh? Look at the data that we have on this stuff, huh? Okay. So like I've already showed you, July and August, euro dollar falls. Is it going to fall this year? Oh, I don't know. I only have 20 years of data. I can't tell you if this year is special or not. But what it does tell you is in the months of July and August, if euro dollar is falling, you have the opportunity to sell it. And knowing the 20-year average shows you that it usually falls for 8 weeks, are you really going to try to make 25 pips? That's what you're worth? Remember, your worth is based on the value of your trades. Value in pips, not dollars. And any idiot with money can have a bigger trade than you and doesn't make them a better trader than you. So it's more like, what are your trades worth? When you place a trade, are you going for 25 or 250? What's the difference? Entering? No. Because you're more informed and you sell the euro dollar and you're like, not only is it going to continue falling, remember, you don't sell on the way up because you're smarter. No, that's dumb. But if it's already falling, then you can say, ooh, based on seasonality, and maybe some other things going on in the market, you believe it's likely to continue falling for quite some time. So you enter exactly the same way, but you let your winners run, and maybe you even compound. So instead of taking 25 pips out of the market, you take out 2,500 pips, because not only did you let it run for 250 or more, you actually added on along the way. Why? You have confidence. Why? You have the data. If you don't have the data and you have confidence, you're arrogant, and that's based on egotism, which is a weakness. It's a failure of your mind. It's like, you're Superman and you can fly, so you're going to jump off a building. Well, I have a problem with that due to physics. I don't think you can fly. But I think you'll fall at the same rate as a bowling ball. So anyways, you have to back your confidence with reality, which is either hardcore data, hardcore experience, ideally both. Ooh, snap. The stock market's open, huh? Why don't I stop a talking and start a squawking? I should have got that right before the open. Sorry about that. Oh, no, it is. 29. Good. Perfect timing. Wow. Unbelievably perfect timing. So we'll see what is said at the market open.
Further from ExxonMobil CEO, does see chemicals demand growing 1 to 2% above GDP?
Yeah. Should be a floating window. I'm not sure what they say at the stock market open. I thought there would be some sort of like ding, 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 ding. Yeah, didn't hear anything special in the open. It's going to be, well, Steve, right? Steve asked a question, is Traders and QuantBox going to be a joint subscription? I'm setting that up now, and my intention is that you can have QuantBox, you can have traders, and you can have both. And there'll be a much better deal to have both, because that's what I want you to have.
Just an update here for the NASDAQ. NASDAQ 100 falls 10% from July high, is set to enter a correction.
Yeah. Uh-oh. Flash Solver, are you a subscriber to this service, Flash? Yes, Steve, it's all going to be one thing in about 30 days. So I got you, bro. I'm telling you, I'm going to revolutionize the way you trade. Okay. I am absolutely going to destroy the old you. Actually, Lucas, by the way, man, I miss you, buddy. Oh, hey, have you ever gone to FarmCom? And the answer is yes, absolutely, totally. And some bonuses and a bunch of other stuff. Like, you definitely want to do that if you can. But hey, have you ever been to FarmCon in St. Louis? Dude, I think I'm going to go. It's killer. It's like 2 days of farmers at a conference center in St. Louis, and they're all talking trading, to hedge their crops and all that kind of stuff. So like options and futures trading, like it's a trading conference for like straight up farmers. And I'm like, oh my God, that's got to be so killer. It's $1,000. I think they get like, 1,000 or more farmers trading all kinds of things, and it's all about money. But of course, there's going to be other things too. But it's basically a trading conference for farmers. I'm like, oh man, not Wall Street a-holes, but the good old boys off the farm, right? I'm like, what a different culture for what I've seen a million times in New York City, right? But dude, we should go, Lucas. Like, oh yeah, and the parties are going to be good, right? We're going to have bonfires inside the conference center. And it's run by this guy who just somehow got, he got married young, and his wife got a job in Chicago, and he needed to do something because he followed her because he loved her. And so he's like, what the hell am I going to do? Because he grew up in Missouri or something on the farm. He's like, I don't know what the hell to do in Chicago. But he got like some clerking job on the floor, right? So he ended up spending 5 or 10 years on the floor, and he learned trading. And then during like 2008 or something like that, when everything kind of collapsed, he decided like, I'll write about what I learned, and I'll just start a little newsletter, right? Now he makes like $30 million a year, Lucas, on his newsletter. And he threw a little party one year, like for subscribers, like, let's get together, let's talk about some trading, and we'll talk about some farming, and then we'll have a steak dinner. And then the next year, like, more people showed up. They brought friends, and they're like, hey, can we go hunting after? And he's like, yeah, all right. So we'll talk about trading for a day or two. And then we'll have our dinner, and then we'll go on a little hunt. It'll be great. We'll do some shooting. Fast forward, now it's like thousands of people show up, and he's making $30 million a year, and he's just a good old boy from Missouri. And he talks like that, and he's just cool. You're like, yeah, he ain't changed none, right? So, I just thought, oh man, I want to go, man. I want to go. I think it would be killer. So look it up, farmcon.com. Yeah, I think I'm going to go. January in St. Louis. Definitely don't want to go outside. Yeah, he makes $30 million, David. He writes a newsletter. That's it. He writes it himself. Oh, and by the way, he has a woman in California that helps him with editing or something. His wife does the accounting, and his son does merch. So there's 4 employees with $30 million worth of revenue. You're like, oh my God, what? You're 99.9% profitable? Yeah. Damn, boy. You're like, good for you. Yeah, it's like selling shovels and picks to the gold miners, right? Yeah. Yeah, but at least he's, he's a farm boy at least. And, I mean, dude, he's like, whatever, good for him. He got out. It's sort of like getting out of the gang, getting out of the neighborhood, right? Like, good for him, man. He got out. Nothing but love. So, yeah, anyways, so, yeah, we got to go, man. All right, so anyways, down, down, down. Let's go back to the QB. Go to the dashboard here. And, oh my God, I'm killing it. This is killer. I love it. And I love the fact we got the correlation back. We haven't had this in maybe even years. Yeah, stocks down, bonds up. Love it. Dude, when this was 5.0, I put some serious money on this. And it's paying off. Now I'm losing in the S&P, but don't worry, I've managed the risk on that, so I'm okay there, but I'm crushing it here now, finally. I'm going to look it up. Sorry about me babbling about myself. I love me. I got to bring it up. By the way, everyone in my Council of Investment Advisors, we have a meeting on Monday for a portfolio performance review. Yeah, I'm down 0.5% today in general. So me no likey that. But where's my 20? Oh my God. Sorry. Oh my God. Dude, it's a good day. It's a good week. Gee whiz, that is insane. That is insane. So I'm doing very well on this falling, but my yield, because we have an option strategy over top of this, we're pulling in right now in income. Think of this as the carry. Don't think of it as a carry trade like the pips. We're not talking about the pips here. When you talk about the swap in a carry trade, it's the interest you're earning on the position, right? Like, for example, let's move off of here. Let's pull up this trade. All right, so I'm up probably close to 2,000 pips now. It seems like I'm up, actually, 1,400 pips. Where am I? Sell. Okay, at 203, and we're at 189. Like, dude, yeah, I'm up 1,500 pips, right? Okay, but I've lost $33 in swap. This is what we're talking about. Okay, now percentage-wise, what we've done is I'm not on the 10-year. By I mean the Council of Investment Advisors. So if you don't know what that is, I manage a very small group and I teach them portfolio construction and management. The same type of portfolio construction I do for charitable endowments. So I oversee 3 charitable endowments and I do so for free, all pro bono. Okay. But like, how do you manage an endowment? How do you construct a portfolio and then manage it? And what kind of variables do you look at? Seasonality, business cycles, event risk, and what do you do to mitigate risk in these portfolios, right? And so I teach portfolio construction, management, rebalancing, rotation, all that kind of stuff. And in that, we bought 20 years, not 10-year yield. We bought the 20-year because it has a different convexity in bond yield. Means it's more sensitive to changes in the Fed funds rate and that blah, 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 blah. It's just slightly better than the 10. But we bought the assets when it was, or the first wave, because we bought multiple times in the year. The first wave, it was 5%. The second time, it had dropped to about 3.85 and then rallied back up to about 4.6. And we bought a whole bunch more at 4.6. So we probably average about 4.8. Think of that as a swap. That's just the income. That's not the price. That's just the swap, the carry in the carry trade, the interest collected. Then we write options on top of it, because to be in a charitable endowment, the money has to live in perpetuity, and therefore you have to protect all the assets from falling in price. So you want as little risk as possible. But on top of that, you need to earn income, because your charitable foundation needs to invest money into its budget. Or if you're a museum, you need to pay rent, and you need to pay for the exhibit, and you need to pay for insurance, and you need to pay for salaries. But you never want to lose money on the principal. So you're ultra conservative on the principal balance of the foundation itself. But then you need to use alternative investing strategies to earn income, because you can have a bunch of stocks that go up in value, but you can't pay the rent with your theoretical increase in the value of your stock. Well, you're like, well, Wayne, you can sell your stock and have cash. Well, A, you're going to be taxed, and then B, well, I guess in that case, if you're charitable, you're not. But then you don't own anything anymore. You've spent the money, and now you got to go back and like find something new to invest in. So you're like, that's not how it works. So you need to have basically something that you can leverage. So you own all these assets that don't really go up and down in value at all, but then you leverage them in different ways to earn income. Now, big institutions that have 20, 30, 40 billion. So I met the Harvard endowment team. I met the Yale endowment team. I met the Metropolitan Museum of Art endowment people. I met the Lincoln Center of the Arts Foundation. I reviewed I've reviewed all their strategies and stuff like that and audited them. It was all part of my master's degree. And so I can tell you, when you have that kind of money, what they end up doing is they get into very long-term illiquid assets. So they'll buy land and plant forests, because in 100 years from now, Yale will make a lot of money. Oh, okay. Well, what if you don't have $40 billion in 100 years of, return? What if you just need to pay the rent every month? So if you're working with small institutional investors and charitable organizations like I do, you cannot have the illiquidity. But you still need to use alternative investing, because on average, when you look at endowments and nonprofit organizations, when they have this pile of cash given by donors or whatever, and you want to use that to earn income, usually your run rate or your burn rate, let's say your burn rate, the amount that you want to live on is 8%. And that's after fees. So if you're paying a hedge fund manager to do it, you want to make 10%, and then pay the managers for doing their job. Your take home is 8%. And the 8% is what your budget is. So $1 million, right? If it was 10%, you have $100,000. So after fees, you have $80,000 a year to go towards your budget. But the thing is, your $1 million never goes away. So it's $80,000 in perpetuity. Now, if you have a good manager, it grows by a little bit too. You add a little bit to the principal without taking on risk. You use alternative investing to be able to produce enough income to hit those targets. And then you're making just a little bit more so that you can cover future inflation. But the general idea is like a small endowment. Let's say it was $10 million for a small museum. Over the years, it collected donations, right? So there's a pile of cash of $10 million. And every single year, that charity has $800,000 to live on. Year after year after year. So if the economy collapses, they make $800,000 a year. If the economy is booming, they make $800,000 a year. And to a charitable organization, that you just want the stability and that you're going to be there year after year after year, right? What I'm getting to is part of that process that we did here. So we own a bunch of 20-year notes. It's an asset. We own the paper, so to speak. I mean, that's what it is. They literally call it that, right? So you own the paper. You own the 20-year treasuries. It's an asset. It's liquid. It's not like real estate or buying a forest or something. It's liquid. I could sell my 20-year note today. And because my note pays, let's say, 5%, and today, if you bought a brand new one, it only pays 3.85, I will have no problem selling my note, and I can sell the note at a higher price than I paid. It would not be a problem. I can get out of that in 1 second. Done. So completely liquid. The paper is going up in value. That's the net asset value. Plus, it's paying me 5%. But 5% is not the 8%. And if I was charging a fee like a normal fund manager would to do all this management, well, I need to get paid first and then they get paid. So if it's earning 5 or 4.8, well, that's not enough to cover the budget nor my fees. That would be after fees, barely enough to cover inflation. So now we need another layer, don't we? So now we put an alternative investment strategy on top of the asset. So now we're going to leverage the asset. So we got this pile of money in the form of treasuries. And the treasuries are worth more than I paid for it. And every year I get 5%. But then we overlay an options strategy. And according to this, it's earning 15.34. That doesn't include the value of the bonds, or in this case, treasuries themselves going up. 15.34. Okay, so if I collected my 2%, right, let's say, so now they're down to, 13.4. And then they minus their 8, and then they put the rest back into the fund. So next year, if we could do something similar, they have a little more income. So they could increase their budget based on the increased inflation. You see? And now you got this pile, and the pile of cash is still there. In fact, it's gone up a little bit. Adjusted for inflation, it would probably be flat. So 100 years from now, that money is still going to be there. Meanwhile, you had a charitable organization running for 100 years, and it was for free. Because for free, meaning the assets never went away, but they earned income and provided the value. But you're right. You see, like it just keeps making money perpetually. And so I can teach you how to do that. I am teaching people how to do that. So in November, we have our small little group. It's not for everybody, and it's not cheap. It's not expensive, but it's not cheap. We started with $50,000, real money in a Wall Street account. I log right into the account and we review everything in great detail. It took me 6 hours to explain the portfolio I'd already constructed. And then on that first meeting, I let them invest $10,000 in cash. I let them make all the decisions. And we've been, as a team, been making decisions ever since. And we're well over, I think we're at $72,000, and I have a pile of cash to continue investing. On Monday, we're going to meet, and it's just a portfolio. So portfolio review. So after every Fed meeting, actually, no, it's a bigger meeting. Oh, I forgot. Oh, I have to do that. So this is a big meeting. It's not a portfolio review. We're going to do some investing on Monday. So after every Fed meeting, we will do things like review the SOM model We will review the portfolio's performance over the last 30 days because we do that every month. And then we'll have some discussions about what the Fed's going to do in the next, well, really, we care about the next 6 to 12 months and how to position the portfolio, whether we should invest or not, whether we should hedge or not. People are going to be bringing some ideas that we can analyze and discuss for future investment. And we may deploy some capital, or we may keep it in cash, because there is cash. I think I put 3 or 4 grand in there. And so what we might do is, instead of investing that into a new, investment asset, we might just park that into like the money market. And so right now it's just sitting there for, earning 0. So we could deploy it into some new asset, or instead we can just like park it in a money market. SPAXX, we have in some of my personal funds, and it's earning, I don't know, like basically the same as the 2-year note. And we can just sit on that until we do want to deploy it, and we can bump up the income a little bit more. So that one investment, no matter what happens this year, I'm going to earn 15%. But I already know I'm already making money, plus the 15%. And this portfolio is so low in risk, it's 90% less volatile than the S&P 500. It has a beta of 0.1. I mean, what the? So anybody that looked at that would say, well, there's no way you can make any money. And that's true. That's usually what that means. I have a Sortino ratio of 8, and people are like, no, you did the math wrong. There is no 8. Oh, I know. There is no 8. You can get a 2, 2.5, but that's extraordinary. A Sortino ratio would be like 1.5, 1.2 if it's good. A 2 if you're good. A 3 would be wow, but you're probably not making any money because you're so risk averse. I have an 8. And people don't understand. They're like, but no, you can't have a Sortino ratio of 8. Like, there is no 8. There can't be. 2 is great. 3 is nearly impossible. Like, 3 is stupid. It must be wrong, or it's only a 3 now, but it'll change, right? No, I'm an 8. It's impossible. Honestly, it's impossible. No one would believe me. And then on top of that, my worst case scenario is I'll only make 12% this year if the markets fall. The long-term average is 8. So I'm going to do, no matter what, every year, 50% better than the long-term average in the stock market. And I have extraordinarily low risk. And what the Sortino ratio means is, how will the portfolio that we've constructed at the CIA, how will it perform in a down market? Well, we might have just hit a down market. I predicted it in January, by the way, and I said this down move would last until October. So just be prepared. This might be a thing. So how will the portfolio that we constructed at the CIA, how is it likely to perform quantitatively, of course, because this is just math? How will it likely perform in a down market? And according to the math of what we did over the last 8 months, is significantly, like very, very significantly less bad than the average. And the average being the S&P 500. And probably very, very significantly better than if you had your money in all the sort of NASDAQ AI unicorn stocks. You'll probably, you'll take a bloodbath, and I'll do perfectly fine. My net asset value will probably decrease, let's say 15%, while everyone else is losing 40%. But I'll still be earning 12% cash. I don't mind. And then what I'll do is, when it drops, let's say I'm not saying this will happen, but let's just say that NASDAQ drops, it's dropped 10. Let's say it drops 30. Well, I'm earning all this cash. I get all this free money every month. I get paid every month. All this free money will keep piling in. And what I'll do is I'll just buy more at the bottom. When everyone's panicking, there's blood in the street. Well, I have 20 years of seasonal data. I'm pretty sure I know when it's going to be over. And there's nothing but blood in the street, panic, everybody selling. I'm like, cool. Let me buy some. So I do this at the CIA, and I do it with real money in my corporate pension fund. It's a legal entity. Yeah. It has its own EIN. It's like a social security number. It's a real living, breathing organism. Well, in this case, organization. But it's real. And that's happening with real money. And so we will be meeting on Monday, and I'd like 1 or 2 more people to join. So, right? Stay tuned. Or get involved. Send me an email, wayne@fxbootcamp.com. Yeah. Yeah. I'll just type it. You email me there. It's not cheap, but if you have a retirement account, in particular, if because I'm familiar with U.S. taxation regime, if you live somewhere else like Australia, Chris, I don't know the taxation there, but so we can talk about that. Well, I can tell you, you would just have to, depending on how retirement accounts work there, you would talk to your accountant and say, well, you know, I'm in this, on this, you're on my council. It's like an advisory board, Chris. So if anyone wants to become a professional investor, like a financial manager, okay, if you ever want to become a financial manager, you will learn a lot. But here's the other thing. My track record becomes your track record. You'd be able to say, I sit on a council of investment advisors overseeing a real pension fund, which is the model for 3 other endowments. And my performance is a Sharpe ratio of 1, a beta of 0.1, a Sortino ratio of 8, and an income of 12% a year. And I'm telling you, that is 10 times better than my wildest dreams. Those numbers are so good, it doesn't even make sense. And this would be your track record. Cool. So I'll wrap up. It's an interesting day. Did you guys like the fundamentals? Did you guys like the technicals? What's your key takeaway? Soon, everything will be in one spot. If you want a platform like mine, I use Trader's Way. If you want to know how to trade like me, the training courses are only $88 a year. 100 hours of lecture, not babble BS. Because there's a lot of gurus out there that just throw kind of like the babble stuff that you can find with me doing on YouTube, where I just kind of talk over the markets and like, yeah. No, 100 hours of university style lectures. Dude, they're no joke. Okay, $88. Okay? if you want to know fundamentals like I know fundamentals, you want to organize your thoughts like I organize my thoughts, okay, you need to go to quantbox.co. You can take a trial, $8. Do it. Okay? And if you want to combine, so here's QuantBox integrated. So in a month, it'll be inside of TradeRs. And don't worry about it. You're not going to have to double pay or anything. I'll take care of it. But, right? The next part of, you have the fundamentals, but then you have the technicals. And with the training and the live coaching, we'll ensure you know how to integrate technicals and fundamentals together. Because like Aussie CAD on the 15-minute chart, it's down, right? This arrow says down, this arrow says down, so that means sell, right? No. What's gee whiz? No, you buy at support. It just means the next leg, right? So check this out. The leg was down, then there was an up leg, there's going to be a down leg, and then you want to buy the dip. You only buy dips at support. You should know that. Okay? So you have the A, the B, the C. Okay? It says this move is here, right? And so WWWD, what would Wayne do? Okay? So on and so forth. So when you combine solid training, the live coaching would do all that. The live coaching would help you develop fundamental skills. The live coaching will help you do the technical skills. In fact, we incorporate now simulation trading and personal feedback and performance coaching, and got all the training. I'm going to do more training videos and all kinds of stuff. And wouldn't it be killer if we had a squawk? And wouldn't it be killer if you got text messages on your phone alerting you to new moves? And oh my gosh, what if all that was in one place? TradeRs will become a complete holistic trading platform for your sustainable small institutional trading firm. Even if you're trading it in the kitchen or in your mom's basement, you will trade like a sustainable small institutional firm with training, coaching, fundamentals, and technicals, everything automated. And me, in your life, I will be your paid economist with a Harvard degree working for you on your team. We're going over all these facts in detail every day. Your future is going to be bright, and it's going to be you and me and us together. Peace on earth. May the pips be with you. May our profits be above average. Thank you to FX Street. Thank you to our moderator. Thank you to you for 3 hours of your life. I appreciate you. I like what we do. I am absolutely, totally convinced that you and I together are trying and succeeding at making the world a better place. And we're starting with your world. Okay? I will see you soon. Have a wonderful weekend.